I'm gonna start this out with calling out Jerry. First out, Jerry. Man, I thought it was better than the Strazza show. Strazza always having internet and camera issues. Number one, we are 5 minutes late. I'm usually more on time. We do try to be pretty close to on time. There's a couple times we run a little bit late, but you know, I see you, Jerry. I'm gonna keep that one in my pocket next time we talk. But good morning, everybody. Good to see you, Wavy, Free Lee. Anybody else in the chat, feel free to jump in. Feel free to say a couple things. Let me know where you're at, how everybody's doing. If you guys have any questions, we're the guys to try to answer those to the best of our abilities. If we do not have the answer, we will find the answer and get back to you. That's one thing I think is great. And also, you have guys with two different types of experience. I'm more of a macro guy with using trend following models on top of it. Kashop's a macro guy, fundamental. We also cross paths and intersect a bit because Kashop understands technicals, as I understand a little bit about the fundamentals, but that's more of our wheelhouse. So feel free to jump in with any questions that you guys have. So starting off, I was thinking about this morning, and nothing stops this train. And if we're talking about the commodity trade, like that's what I think. I don't know what exactly would stop it. Somebody would say, hey, this is going to happen. Well, yes, bonds can, people are like, oh, the dollar. Yes, the dollar can go up. Will the dollar go up in this environment? That would be really fucking surprising, to be honest. So I don't think that's going to happen. So sticking with the high probability bet, I want to say that, you want to continue to be in these trades that you're in because the dollar will most likely continue going down. The question is, how will this affect the rest of these markets? How is this going to affect your portfolio? How is this going to affect, if the stock market is going down, will energy just keep going up? Can that completely diverge for long periods of time? Can we get an understanding of what we're looking at in the big macro landscape to understand where we're at? And that's what we're trying to do here today. So, Kashop, you've been looking at this market just as I am. You see what's going on. You see a little bit of bottoming in the market. No reason to really overreact just yet. You see the dollar kind of stopped around that 100 level, but now it's trying to catch its footing as well a little bit. The war situation, all of these things. What is sticking out to you this week in the markets?
So I think the market is finally starting to price reality in, and it's kind of funny. Two sides of the Atlantic, I think we see two different realities. The US, I mean, we talk about tech and banking being the drivers of the US economy, but the US has such abundant natural resources, whether it's coal, whether it's natural gas, you name it, the US has it. And because of that, I think people in the US are not seeing the pain that Asia and Europe are feeling right now. And I think the market is kind of starting to price that in. So, what do I mean by pain? By pain, I mean people's standards of living is getting lower. And it is a direct consequence of this war. And the longer this goes on, the worse it's going to get because then when your inventory buffers are exhausted, then what do you do? Then the panic sets in. So I think we are kind of getting to that situation. And market is starting to price that in the sense, what do you do when you have a panic situation? What do you do when you can see a crisis coming? Well, you go to cash, and that's pretty much what investors are doing. So they are selling assets across the board. They are selling everything, literally, including gold, and they're just moving to cash. Now, when you say moving to cash, what are they buying? Well, they're not buying the euro because the EU is going to have its own energy crisis. They are buying the US. Why? Well, you have power, you have, like I said, all the abundant natural resources. So people are just flocking to the dollar because that's the safe haven in a situation like this. It's the most liquid asset. They're not even flocking to the treasuries. They're not even flocking to the 2 year where the yields have been dripping. So I think it's a very unique situation. And the longer the war goes on, I think we are going to see a resolution one way or the other. But right now, it just looks like long dollars, short everything else, and stay safe. That seems to be the trade.
Yeah, that's what I think currently as well, which is like stay safe. I don't think it's energy is working. Fertilizer stocks, a lot of them are working. Chemicals working. I think you have to really be tactical in most markets, and this is the reason why I kind of trade them all the environments the same, which is understanding where the strength is and really sticking to that. Because if you're looking at it and going, hey, in the best markets, you still want to be in the strongest things. In the worst markets, you definitely want to be in the strongest things if you're in anything at all. And sometimes, if you really don't have a feeling for where you want to be, like there's nothing wrong with going to cash for a minute and waiting for where you want to be. But I also looking at the market and just seeing the environment and so on. Like this is very stagflationary. We've been talking about the fact that we're going to run into a stagflationary regime at some point. It seems like we are in a stagflationary regime currently. And with the war situation, like a lot of people aren't understanding like what this all really means. They're thinking like we clear up, like let's say the war ends tomorrow, which I would be surprised, but let's say it ends tomorrow. If this war ends tomorrow, that does not turn into a situation that everything is fine for energy. Like energy prices will stay elevated. Like you got to think like this like remember COVID. You have basically the COVID situation, and as that happened, you had all the supply chain issues. Yes, the Fed dumped a bunch of money in the money supply, and the governments were giving money to anybody with a pulse. Great, but also it's the fact that all of these supply issues continued to hang on and elevate energy prices and commodity prices for a long time. So looking at this scenario, like if it ends tomorrow, like we still have to start shipping all of these things. We still have to restart all of this. Then that restarts the refining process. Then there's also like areas that have been rationing fuel currently. Like people in the United States, they have no idea because they're like fuel costs are high. Look at like Europe, for example. There's a lot of places in Europe who's dealing with it. There's a lot of places in Asia that's dealing with it. South America, Brazil's dealing with the fuel shortage problem currently. Australia is dealing with a fuel shortage problem. Africa is dealing with a fuel shortage problem. Like it's everywhere basically, but North America currently, and it could be coming soon to you. Like so be ready for all of these things, because if this continues, it's a big thing. People just think it's going to affect them, and we produce here enough to have enough oil and gasoline for the rest of our lives. We have a lot here, but not enough. We do import a lot of oil. We do import a lot of energy. So, once again, be careful with thinking that way and thinking that this is all just going to turn out just fine. It's probably not. It's going to take some time to run through the system. And so when I look at this and say nothing stops this train, if you guys remember the scene, it's a fantastic scene. If you've seen Breaking Bad, I'm not a big person on TV shows, but this is one of the best TV shows I've ever seen. And there's the point where like they're all kind of like, I don't know how to do this. I need to, we need different methylamine. We need this. We need that. And he's just looks at them and like, they're arguing. He's just like, nothing stops this train. The methylamine keeps flowing, so he can keep making meth to keep making money. Because at this point, he really doesn't even need the money anymore. He's just pretty into the fact of he wants to be a kingpin. And that's kind of like what I see with the oil market currently. Nothing's going to stop it. Nothing's going to stop that from going higher. Nothing's going to stop the gasoline prices from rising and putting pressure on economies. Nothing can stop it. So we're in a stagflationary era currently, in a stagflationary cycle. So if we're in a stagflationary cycle, we need to just be looking at what we should be buying, what we should be selling, and also knowing that the broad market could be under some pressure for some time. Still like cyclicals. I think there's a lot of value in looking at the commodity sectors and looking at commodities themselves. And we'll go through some of those today. But other than that, I think we're in for some stagflation here. I think that would make sense. So I brought this chart. And so when we're looking at this is a chart, and Shop, I thought you might dig this one because it's kind of showing the huge moves that happen in commodities over time. So, you go back to the 70s, that's the stagflationary era. You have the big move that happened in sugar, 2,000%. You have silver, 3,600%. You have oil, 1,500%. That's not to mention all the other, I couldn't list all the commodities. It would take up too much space on this chart and it wouldn't even fit. But there was all the commodities basically in the 70s made huge moves. Oil was the last one, made a big move into 82. Then we had nickel, 600%. Then we had wheat, 100%. Then we had palladium, 800%. Then we had nickel, 700%. Natural gas, and so on. Like you guys can read the charts, but there's been some huge moves in these commodities over time. So, when we're looking at this type of era, I want you guys to stop thinking about the fact of, there's so many things that I can't buy. Start thinking of what areas you want to start looking for. And then also these returns are great, but also think of some of these stocks inside of these sectors went up, quintuple that. So once again, you can make a lot of money during these periods of time, but you have to really know where to look, and you have to be willing to think outside the box and not think in the box of I need the S&P 500, I need the Mag 7, I need this. Remember the 1970s, and Kashop, maybe you could go into this a little bit deeper, but we had the Nifty 50 stocks in the 60s, and those were doing great for a long period of time. And then basically everybody said, hey, I want to put all my money in these Nifty 50 stocks, and that's it. These are going to be the stocks of the future. And then they topped out right about that point, and then it went sideways for what was it, 12 years? So Kashop, you could talk about that a little bit more.
So I think I'm sorry about my voice, guys. So almost no one in Wall Street right now has seen a era where the S&P goes sideways for 12 years, and it's happened. So all these stocks for the long run, all these books, they all sound great, but then the reality is they were all written in a bull market. It's as simple as that. In a bull market, everything is going up, things are great. Whatever you do, you make money. And in a bear market, well, whatever the things that worked in the bull market are going to stop working. So the Nifty 50 was one such craze where the greatest companies in America, the valuation doesn't matter. Japan had a similar cycle where 500 Ps, 1000 Ps, all of it was fine because the Bank of Japan was printing money. And Peter Lynch, one of the greatest investors of that era, in his book, he has a quote where he says, how do you know this dog is worth $1 million? Well, because you can go to the pet store and you can get two cats worth $500,000 for it. So, that was the kind of silly valuations that were prevailing back then. And we kind of saw the same. No, I'm not even going to talk about the current bubble. So, go back to 2014. China was the hot thing. Everyone was talking about Tencent, Alibaba, Baidu, Meituan, all these Chinese giants. And what were they saying? They were like, Morgan Stanley is going to change their rules. And because Morgan Stanley is going to change their rules, everyone's going to start buying Chinese stocks. So I'm going to start buying ahead of the people, ahead of the institutional crowd. And then there was a big rally in all of the Chinese stocks. And then Morgan Stanley said, hey, we're not going to change the rules. And everything crashed. And since then, until 2024, so for 12 whole years, 2015 to 2024, Chinese stocks were dead money. Now, can you imagine world's number two economy, the stock market doing absolutely nothing for 10 years? In fact, it's going down. And a lot of the companies got into serious trouble as well. So, can you imagine that happening to the US? Well, no one can imagine it, which is why when it happens, everyone will be surprised. And the thing with reading history, looking at all this, is that it is not that what happened in the past is going to happen again in the future. It is just so that when it happens, you have a framework in which to frame these events. For instance, we are talking about the AI bubble bursting, and we are going to look at 10 years of Max 7 underperformance. Well, can you relate that to anything? Yeah, you can relate that to what happened in China. And right now, again, another example from the current war situation, what the US is going through right now with Iran. Britain and France went through the same thing with Egypt when they invaded the Suez Canal in the 50s. So that was kind of a break moment for the remainder of that empire. So when you see these events, when you read history, you can sort of put them in context and you can figure out why things happen the way they are. And that helps you prepare for what's going to happen in the future. So I think that's the most important takeaway from studying the earlier cycles.
No, I agree. I think that's what you really want to study history, because then you're not really surprised by anything that happens. Like it's like, Kashop said last week, hey, the Mag 7 could underperform for, 10 years, and that sounded crazy to people. However, there's been plenty of periods of times where the leading stocks have held the market down for 10-year periods or longer. So once again, that's not that insane to say. Want to answer this question. So Freely said, if oil is going up, why do ETFs like KSA continually go down even before the war? Freely, you should also understand this completely. I am long KSA, so therefore it doesn't want to go up because it knows I'm long it. I'm just kidding. But once again, if you're looking at like some of the once again, there's never going to be a one-to-one correlation, right? And there's never going to be like the same things that are affected will be affected perfectly. Yes, Saudi Arabian oil will be affected as well, but at the same time, it's not something that I can say because of that I can just buy it. That's the hard thing about the commodities market, which is like it is always confusing. Like think about gold, for example. When gold started to move a couple years ago, nobody had any idea why. There was no news around it. There was nothing. All we had was a breakout and a signal to go long. Now, yes, guys like Kashaf and I could sit there and come up with a ton of different ideas why this is happening, but it just was happening. And then, a few weeks later, you start to see news come out that central banks are buying more gold than they've ever had, and so on. And so, you start to see that stuff later. So once again, it's always based on the price. You get it. For me, if I get a signal, and even if it's just chopping around for a while, not stopping me out, I will stay long that position until it gives me a reason to completely get out. So KSA is one of those where it's really not going anywhere, really not going up and down, just been a frustrating trade for a while. And once again, then there's a lot more dynamics to a country ETF than just playing like an energy stock by itself. If we could buy Aramco, that would be a whole different situation probably. But sadly, we can't buy certain things. So looking all over though and looking at these different sectors, like, not everything's going to perfectly correlate. Like even like think of Kashop, this, think of the Canadian dollar and oil. Canadian dollar and oil were pretty tied at the hip for a long period of time, most of my life, and then all of a sudden Canada started doing different things with their monetary policy, their housing structure kind of changed, a bunch of things changed, and next thing you know, not to mention how much oil they were actually producing, and next thing you know, the Canadian dollar and energy prices weren't going hand in hand anymore. Same thing with the yen. The yen used to be a risk-off currency. That's funny to say today, but the yen was a safe haven. You basically ran to the yen in times of strife and turmoil, and then we got to the scenario that we're in currently today, which is the yen is garbage, and you really don't want to own it by any means. Whatever market environment you're in, it's not something you want to own currently. So these things change, and maybe something will come out that we're like we look at Saudi Arabia and something in the next year and go, that's someplace we just don't want to ever be long. For some reason, we'll find that out over time. But it's going to take time, and the reasoning's never going to really be known until after. But Kashab might have a better answer on that. So Kashab, what do
So
you think about Saudi Arabia? I feel like you're going to have something and be like, this is exactly why, because you usually are the guy that knows these things.
I looked at the ETF, and I think it has a lot of bank stocks. It has a lot of other basic materials. It's not just oil. So the correlation between those companies, what they do, and the oil price is not that high. So that's your answer. And generally, when you look at any country ETF, so not just KSA, when you look at any country ETF, even though, let's say, you think of Colombia, you think of coffee. But if you look at the ETFs, the way they are weighted, they will have much higher banking exposure than exposure to other sectors. And the reason for that is simple because in a lot of smaller countries, banks are the first to get listed. And banks are the main way that investors like to play the economy. So the banks have a higher weighting in a lot of these ETFs. So you want to be careful of what you're buying. Now, if your view is I want to be long global oil producers, then you should find an ETF which has Aramco, which has Total, which has Shell, which has all these Ecopetrol, all these other companies, like you should buy an ETF like that rather than the XLE, so or the KSA in general. So if you do that, then you can actually get the correlation that you're looking for. If you are going with a country ETF, then you're pretty much taking a bet on the banks. That's what you're doing.
Yeah, so you always got to understand what's inside of these things, and at the same time as we Saudi Arabia is a area that we could be in, and that could be a great long. You also want to understand the construction of the ETFs. I do think even with the current market environment, if we start to get a rally in the market, this is a time where everything's been getting hit. We start to get a rally in the market, things start to smooth out. Let's see, we're in a scenario very similar to 21 where tech is a massive underperformer and everything is massively outperforming and the dollar is still weak. I think Saudi Arabia would be a great place to be. right now the banks are taking a hit globally. That's going to put a lot of pressure on that. So getting through the deck, bunch of stuff to get through. Let's hop through some of these so we don't get stuck. US inflation in the 1970s versus today. So this is a chart, and you guys have seen me update this for a long time. You know, everybody goes, "Oh my gosh, it's got to go." It's never going to be perfect. You're never going to put this together and be like, "This is exactly where it goes." But if you do look at it, the lows from the current cycle are a little bit forward, past the lows of the last cycle. So it is something that like it would make perfect sense. And here's the other thing: there is no fucking way in hell that the next CPI report is going to come out and it's going to be low inflation numbers. like that's a complete. I've heard so many people talk about this. All I'm seeing is deflation. Where the hell are you seeing deflation right now? And then they're like, okay, so I'm seeing deflation. It's everywhere. And I'm like, look, the biggest input and the only commodity that's listed by itself anymore in this US CPI is gasoline. And not to mention the inputs for all of these companies, trucking, shipping, whatever it is gasoline, oil, heating oil, and so on, diesel, jet fuel. I mean, come on. Do you actually think like let's say it comes back a little bit. These things are up at like even if they stay like around a level that would make sense for even the war situation ending, we're talking about a rise of 50% at the very least in energy cost across the board. Like that's insane. So like if you're looking at that, and not to mention coal prices are just raging, people don't think about that because that's one of the biggest inputs for utility costs as well. So coal prices are raging, oil is raging, gasoline is raging, diesel is raging, jet fuel is raging. There is no way to make a low inflation print to the point where like nobody's going to be worried about inflation. Go to the grocery store, you're worried about inflation. And then go to the grocery store like in next week, it's going to be higher and it's going to continue to be higher. That's the thing I kept saying about gasoline prices. They can't come out and, if let's say gasoline jumps 50 cents in a day, they can't go to the gas stations and then just raise them 50 cents. Like they don't do that back and forth. They don't just sit there watching it. They do it slowly. So it's incremental. And then as time moves on, like that's why like you'll see like you'll go outside and you'll look at the gas station. You'll see, oh, gasoline's down today because whatever, Donald Trump made a tweet and lied about something, and Iran came out and said I mean, this has happened like 5 times now. Donald Trump will make a tweet and say this is what's happening, and Iran's like, this is not what's happening. So nobody really knows what's happening. But anyways, he'll make a tweet. Let's say gasoline prices drop 20, 30 cents. You'll still go to the gas station and see that they continue to raise the prices. So right now in Ohio, we're at around $4, so that's the highest I've seen it since COVID. We got around $5 at one point during COVID, but $4 is a big change. If you look at the Gas Buddy app, this is a great app to use for you energy traders. You can see nationally what's going on with gasoline prices state by state. This is really important because you're seeing like most of these areas, it's going up a lot. California had some refinery problems, and it's gone up a lot more in California. So we're seeing really high gasoline prices come in, and they're sustainable. They're not going to go down. So that's going to go in the CPI report, which is going to create that next wave of inflation coming in. And inflation is also very psychological. The more people see it, the more people believe it. I mean, this is the reason why most of the time, remember the last couple of years, I mean, metals have been raging, just raging, precious metals especially. Then we had the base metals, then we had industrial metals, then we had lithium, then then we had nickel. Like all of these things continued to rage. However, that's what the CPI looks like because that didn't get into the inputs yet. So the inputs into the CPI report are things that you use every day, car prices, steel is going to take some time to get through the system to the point where, okay, Ford's paying a lot more money for blank. That's going to be something you have to think about. So as we continue to go through the system and see like all these companies are paying more for this, semiconductors cost more because of the metals in them, building houses cost more, pipes cost more, everything costs more. And now you're going to add to that equation energy. This is about to get out of control. But Kashop, what do you think about inflation? Do you think do you think I'm onto something with the stagflation thing? Do you think it's crazy, or are you buying bonds and retiring?
No, I think inflation is going to hit in ways that we can't even think about right now. So I was just thinking of this today. So Taiwan is going to run out of electricity, is going to run out of energy supplies sometime next week. What happens then? If TSM, Taiwan Semiconductor Manufacturing Company, so if the big guys who make everything for Apple and Nvidia and all the big tech firms, so the foundry of the world, if they shut down or if they have to halt production due to lack of electricity, lack of something, what happens then?
Yeah.
Everything goes through the roof. And we kind of saw this in 2021 where Tesla cars were held up in production because the one chip that they need to raise and lower the windows, that wasn't available. So what does that do? And that was the time where we saw used car prices hit a peak. Now, why did that happen exactly? We don't know. We just know that there are second and third order effects in the economy. And once that's taken out, it's a troublesome period. So in mining world, the example that's a lot closer to home for me. So sulfuric acid is needed to leach copper out of oxide ores. And what do you do when you run out of sulfuric acid? Well, the Middle East accounts for 25% of world sulfur production, and that's all shut. So, how long is it going to be before mines say, hey, we cannot produce copper anymore because we cannot leach the ore because we don't have the acid or we don't have this reagent or that reagent? And then what happens to the copper price? Well, you don't know. And if copper price suddenly shoots up, then what happens to the other industries which are dependent on copper? Well, you don't know. So there are all these second order, third order effects that we cannot predict right now. So it's impossible to say this is going to happen, that is going to happen, which is why I think safest thing is to bet on cash and long term. If you can buy metals, not just the near term contracts but the farther term contracts, then I think that's a good way to play it because I think there's just going to be a shortage in everything and nothing stops this train.
Yeah, I think there is like straight across the board, like we're looking at like that's the thing. People keep looking at just oil because it's the one that's moving, as they should. Like if you want to be long something, the energy sector is the place you want to be. But also remember, like this is definitely going to create supply issues across the board in all of these different commodities. The grains are definitely going to be one of them. Food will be, just across the board, anything food wise. And we're starting to see it in certain areas. We're starting wheat prices have done really well. But real fast, just going through that, we're going to get to that. I have a bunch of charts on some of the individual commodities, some of the stocks, and so on, the energy sector. But just going through the cycle, I highlighted this yesterday, but I wanted to bring it here for the Holy Macro Show just to show you guys. Like this is what I mean by the cycle. And so this one's a messier chart. I usually use a much cleaner chart so everybody can see it. But this is showing you the indicator. So 52-week highs is how I've quantified this. And as you can see, like gold hits a 52-week high all the way here, and that's in 2001. And then, the next 52-week high is hit by copper, and that's in 2002. And oil hits it right around the same point that copper does. And then we get to the next part of the cycle when we're coming out of that great liquidity event from the great financial crisis. We had a 52-week high in gold here. Copper hits it right around the same time. Oil hits it just after that. So these weren't far off, but that's also liquidity events usually create like wild rallies that can kind of happen at some point. So that was true reflation at that point. Just everything was moving at the same time. Gold hit a 52-week high here. This would be 2016. Copper hit it shortly after that. Then oil hit it shortly after that. And then getting to the next parts, like gold hit one here. Nothing basically moved. Like copper moved down, and then it hit a new 52-week high pretty early. So that was only, in 2019. This is when gold hit it. In 2020, copper hit it. And I think that was 2021, oil hit a 52-week high. So now we're looking at this current cycle, which is gold hit it in 2024, copper hit it in gold hit it in the end of 23, copper hit it in mid 24, and then we're looking at oil, which didn't do it for a very long time. Now, the cycle, the way it works is it can take up to 16 months. This was the longest lag I've ever had in that cycle. But I held true to the fact that this usually works the same way. You know, Kashop and I got a lot of comments when we were coming on talking about gold and how we're buying miners, and then silver is going to move and so on. And the comments were constantly, well, you know, central banks aren't buying silver, central banks aren't buying gold miners. The cycles usually just work the way they do. We could say it's, you know, somebody could say it was exacerbated by the war, or that's why this worked. I mean, before the war situation happened, energy stocks broke up. A lot of people forget that. Before the war situation happened, oil bottomed. A lot of people forget that. So, you know, continuing to run through these cycles is going to be important. And looking at Europe, and this is what I want to ask Kashop. You know, me and Kashop have been trading together for a while, and I don't think we've talked much about Europe besides I remember making like a Greece trade in 2019. And that was probably all we've talked about Europe over the years until basically 2025. We started to see Poland move. Then the next thing you know, I'm longer Europe than I've ever been in my whole life. I'm long currencies in Europe, things that I haven't, you know, done in years or even looked at. So are you seeing any value in Europe? You know, I want your opinion on this because you're the guy who actually would know what you're really thinking about Europe currently, what's really going on about with Europe. So is there any areas besides, I obviously see, and I've highlighted Norway. Norway obviously looks good. We all know that. It's a energy heavy. The biggest stock in their index is, I think it's Enor, which is pretty energy, which is all energy. It's an oil stock. So moving on from that, is there any other areas in Europe that you're looking at that you think we should be looking at for stocks?
I recently bought a London listed bank. I wrote the report for subscribers as well. So I think you need to start looking at the financials now. And the other sector that I've been bullish on for a while is the luxury space. The reason for that is 2022, China had its zero COVID policy and luxury took a massive hit. But I think that was the first year that luxury has gone down in probably a decade, and now it's starting to come back up. And it's not going to be like the COVID era where the Fed prints money, everyone feels rich, and then they go and buy a Gucci or a Louis Vuitton or something like that. So it's not going to be that. It's just going to be secular, steady growth, mainly driven by Asia coming back, China coming back, Middle East coming back. So that was a trade thesis that I had last year when I bought luxury, which is working out okay. I think that trade still has a room to run, and I think the banks look really interesting. Now, the reason the banks look interesting is because I mean, European banks since 2011 until now, you were better off just staying away. So some of these trends run their course for a very long time, and when they mean revert, it looks like a change in trend. So I don't know if European banks are going to have a secular growth moment or it's just mean reversion from a very long downtrend, but I think those look interesting. So those are the basically the only areas, luxury and banking. I'm not looking at anything else.
Yeah, it's a tough one because that like PE ratio value wise, there are some areas that you could really look at and go, okay, these look really good, but also a lot of these places are very dead money long term. But there's also some things that are looking good depending on the year. So once again, if the dollar continues to go down, I think we'll still see a big rally in Europe. But we need to see the dollar move down, and we also need to be in a better liquidity environment that isn't stagflationary. I think that oil prices will wreck Europe over most places. You know, like if we're looking all over the world, United States is going to be in some trouble from that. Yes, the stock market's going to struggle from that as well, but Europe's going to get hit probably worse than anybody else, which is probably what's going to give a boost. If something boosts the dollar, that would be it, because the euro is over 50% of the dollar index. So if the euro is going down, most of the time the dollar is going up. So that's like a lot of people think the dollar's just strong. It's doing so great. Everybody loves the dollar. No, most of the time it's the euro is just really weak. Europe is really weak generally most of the time because their economic growth models are not usually running to the upside anymore. Inflation is really out of control in those areas, and it's even worse than it is here in the United States. A lot of people aren't putting that together. Not to mention, then you add this war situation, energy costs, and so on. It's going to be a big problem for Europe. So that's something to keep in mind. Speaking of other countries, we were pounding the table on Brazil quite a bit. I really liked Brazil. It was an area I'm still in currently. I still think this has a lot more upside to go. So far, it looks like we had a false breakdown signal. We kind of undercut that low. We bounced off of this zone as well. Now we're back above 3581, probably heading to the upside. So this is an area, if you guys wanted to try to get exposure to Brazil, this is the time you would do it. But I just want to ask a shop, like, what are you thinking with the war situation? South America, is it still as appealing, even with energy costs going up as much as they are? Or do you think it's not as appealing anymore?
So there are a lot of investors who have to be allocated to equities. And if you're looking at equities world over from that perspective, then South America is a safer place to be than Asia. It's definitely a safer place to be than the Middle East. So you would probably allocate a little out of the US and go into Europe and South America. So in that sense, it looks good. Now, Brazil particularly, I think they are having problem with diesel deliveries. So if they run out of diesel, then God knows what happens next. So I think that's really the fear that the market is in, because right now things kind of look scary, but everything is normal. But if things really get to a panic situation, then what happens? So I think that's the question, and that probably explains that false breakdown in the EWZ ETF as well.
Yeah, that makes sense. And so Jonathan said PBR. I'm just for me, yes, that stock's great. I'm long it as well. But every time I see PBR, even though I haven't drank in 15 years, I still think of the alcoholic drink that, like, especially when I was that age, I got clean in my 20s. So like being like 18, I didn't start really drinking until I was 21. So 21 to 25, I drank a lot of PBR. So every time I see it, I kind of get this like sick feeling in my stomach still from like drinking those, because they were like disgusting, the cheapest beer in the world. But shout out PBR. So anyways, side rant, I do that sometimes, bear with me. Here we go with cotton. So cotton is starting to move, and this one has been in a very long-term band squeeze on a weekly chart. Basically dead money. And this is the thing I like to see more than anything else in the market. If I want to see a setup, and I'm talking stocks, commodities, currencies, crypto, you name it, whatever it is, I want to see this thing look dead as fuck before I really want to make a move. Commodities especially, because commodities usually V top and they don't really V bottom nearly as much as stocks do. So, if this thing's good and dead, and so that they V top and then they also base at the bottoms, which is the opposite of stocks, where they usually base at the tops and then they V bottom at the bottom. So this thing is making a nice bottom, very long term, hasn't done anything, was stuck under that 200-day or 200-week moving average for a very long period of time. Then it got over it, and it's not really looking back and coming out of that band squeeze. So I think that that's an area that we want to continue to look at to go. And this is for you futures traders. I'm sorry, guys. I don't even have stocks that I can say correlate it heavy to cotton. Some people will say China. I think that's bullshit. I don't think that's something that you should trade on ever. But, cotton futures are a place you want to be. Sugar. And there is an ETF for sugar, actually, which is called Cane, CANE. Great name for an ETF. Makes me think of that one clown that talked about cocaine. I can't remember. That was like a show on Adult Swim back in the day. If anybody can remember, drop that in the chat. But anyways, sugar futures starting to get up and over these major levels, up over 15 cents, 15.25. We really like it. We'll see if we can end up continuing higher here. Now remember, sugar doesn't have great seasonality going forward, so this could be one of those false moves that just kind of comes back down. So be careful with that one. But however, it is making a new high. That is a 52-week high. Sorry, that's not a 52-week high. Sorry, that's a 100-day high. So as it's making a 100-day high, it's interesting to get long it in this zone. I am long it in my personal portfolio. I'm waiting for another signal to take a full position and actually update everybody on if I'm taking that. But I usually don't list some of these smaller futures in the portfolio most of the time because not a lot of people trade them, and the ETF is honestly not that great, so I wouldn't be that interested. So Kashop, looking at the bond market, the bond market is so interesting currently because everybody's excited about it. You know, I only way I can explain it is the same way I've been explaining it, which is, you know, when you're a kid and you know you're younger, you have like a TV in your parents' house, and you're like, I was like 12 years old. I remember all my buddies were at the house one day, and we were sitting there on Cinemax, trying to like see boobs on the TV. So we're grabbing the rabbit ears on top, we're like moving them around. You know, the TV's like all blue and fuzzy, and then you might get like 5 seconds of seeing like a boob or like an ass, and you're like, oh, that's so exciting. You know, this was, guys, just so everybody knows, this isn't a period of time where you could just go on the internet and find anything. So once again, times were a little bit different back then, a little bit struggle bus at times, but that's how I explain the bond trade. Every time it's kind of like everybody's like looking for something. They're like, oh my God, we got a green candle. See, Jason, bond market's great. It's going to go up forever. You guys are stupid to say the bond yields are going to go higher. Look at TLT. It's going to rip right now in everybody's face. And then it falls back on its face almost every single time. And everybody goes, how did that happen? So, you know, what are you thinking about the bond market? What do you think about central banks globally? You know, is there anything you're seeing out there that we should tell our people about?
I think bonds are an avoid. Everywhere in the world, every duration, avoid them. If you can find something under a year, maybe under 2 years, if we have a long term horizon, that's it. Other than that, just avoid them all. And the reason for that is, well, new supply gets added every day. And who's the natural buyer? The Federal Reserve, that's it. China's not buying, Japan's not buying, the Middle East is not buying. Wealthy individuals, households, they are not buying. They're all sticking their cash in money market funds. So who is left to buy these bonds that governments keep issuing? The answer is nobody. And that's why you're seeing yields rise, and it will continue to rise as inflation picks up. Because that's the other thing. When you are in a high inflation environment, the longer you hold bonds, the more money you lose. Now, if you enter, let's say, 2 years, so I think 2022, the peak inflation according to the CPI was something like 9 or 11%. Now, imagine you have 2 years like that, and you have these bonds that are yielding 4%, and you hold this through. How much have you lost? Well, a ton, because the CPA doesn't even reflect reality. So you probably lost something like 20-25% of your wealth in 2 years. Now, is that something that you would consider safe, being in something which has a sure shot of giving you a 9% return, but a probability of giving you a 25% drawdown? Now, if you look at it as a trader and you say, I am willing to take a 25% drawdown on this trade, provided I can get at least a 50 or 100% return. Now, that's the way traders would look at it. Bonds give you the opposite. So I would say in this environment, it is just something you should completely avoid.
No, I agree. I think we're at we're at that point where it's like, it's just funny because people look at bonds and go, they're cheap, you know, and it's like, have you ever seen a long dated bond yield chart? This is where we could go. You know, people just think like 4% is insane. Historically, that's about average. You know, 5% is about average. 6% is even about average. That's not that insane. And not to mention, we're in a long-term uptrend. So this is a cycle chart just kind of showing you the 40-year cycles that we're in the bond market. So it was 38 years from 82 to 2020, and now we're moving up. Now, granted, look at this one. You know, we have ups and downs. It's not just going to be a straight up and down road or a straight up road. This road's going to wobble. There's going to be a lot of volatility. You're going to have to give this thing some room to run if you are on the short side of the bond trade. And so the 30-year looks even more. It looks like it could definitely move at any point. I noticed this one today. You know, we're over those highs that happened last year in 2025, 24. I think that was 24 actually. And now we're approaching that high. I think that was about what 5.25, I think was what we hit in 2023. So, or 22. So I think we're going to get above those levels. Like, I think this is something that people just want to put on their radar. And this is something that you like really have to pay attention to here is global bond yields. I mean, Sam was updating me yesterday with like chart after chart after chart of like every single, like he's gone, France is at a new high. This is at a new high, like Portugal. I mean, literally you go down the list of any emerging market, developed market outside of the United States, and you're seeing they're all in strong uptrends. and they are not folding over or turning around. I mean, Japan, everybody knows that's been a massive uptrend, all the way from some of the lowest levels in history to one of the highest levels they've ever been in history. That is the highest in the 30-year. I think the 10-year, it's approaching that currently. And then the 30-year in Germany, that's been trending up in the same way. So that was also another one from their lowest levels in history. Now it continues to move up and trend higher. And that's in a very strong uptrend. Yields in Canada, that just broke out recently, hit a new high. So that's something that we have to pay attention to too. That's a very large developed market as well as Germany. And then if we're looking at the US is the only one that's been stuck in this range for a long time. Great Britain was one of the first ones to really break out of that range pretty early. So that's already broken out of that range. Now it's kind of trending higher. Looks like it could even go higher. All of these across the board look insane. What about shorting bonds? Jonathan says, yeah, I'm short the bond market. I have been very vocal about that. I've been short the bond market since 2020 with one exception where we got one 52-week high. It literally hit that 52-week high and just rolled over. It was like a day later or something. I can't remember. It was like the Fed came out and said, we're cutting rates. And it hit a 52-week high around that same time. And then it just rolled over. Yield started going higher immediately as they started to cut rates. So once again, this is something that you guys have to understand. The Fed does not control the whole bond market. They do not control the whole yield curve. They control the short end of the curve. So the 3-month bonds, this is why Kashop keeps saying, if you guys really need to buy bonds, like let's say you're an allocator, you have to buy bonds, buy those short dated bonds. Those are the only things that make any sense currently. And so like, you could be long even, and as a futures trader, and Jonathan, you know this, you could be long the short end of the curve, those 3-month bonds. You could be short the 30-year bonds and kind of making money that way. But for me, I think the money's really going to continue to be made on the short side. I think that breakout's coming sometime soon. So looking at the yield curve to commodities, this is not really commodities. This is energy-based commodities. The CRB is very energy heavy. This still looks like there's an uptrend going. Looking at the intermarket analysis, this is kind of just telling us that liquidity is coming into the market and it has to go somewhere. In a stagflationary environment, it ain't going in the Mag 7 names. That's all I know. So if it ain't going in the Mag 7 names and you got a strong uptrend in energy, you probably want to stick with that currently. And so here's the midstreams. And so we're looking at all these different sectors inside of this. So just wanted to kind of show you guys like there is extreme strength in the energy markets. All the groups are above all moving averages. All these groups are very strong. And all are, I think every single one's above 52-week highs, which is actually pretty crazy. So when it says negative, what that's telling you is that like it's not below a 52-week high. It's that much above a 52-week high, which means it's still trending currently. So Kashop, areas in the energy space, are you looking at fertilizer? Are you looking at agribusiness? Are you looking at anything else in the energy space and some place that people can start to look to find some of these stocks? I know you and I talk about it on our channels all the time. I have a Substack. Kashop has his own page as well. So we talk about these things on our channels all the time, and you guys can check those out and find, we keep the trades for our paid subscribers, but we do put out a lot here too. And so we do give trade ideas sometimes. We do give some things out. So I'm just looking at what areas do you think are where we should be positioned in the energy sector? Do you think it's time to start getting into the small cap names? Do you think the refiners are where you still want to be? Do you think this thing's extended? Wait a minute, whatever you're thinking about this, but mainly where's the best sector where people can make the most amount of money is mainly what we're looking at.
Sure. So I would say this is not overextended, and no way. So overextended, you have to look back to 2022 when everyone was long energy and you had guys posting screenshots of their awesome returns. The energy space on Twitter was starting to look like crypto. So that was overextended. This one is everyone knows energy is in a bull market. Everyone can see there's a war unfolding. Everyone can see the effects, and they are starting to position that way. It's similar to when we saw ChatGPT come out, and people are like, "Oh, this AI is probably going to do some things for tech. Let's buy some tech stocks. So it's that moment for energy stocks. The reason it looks overextended, your RSI is elevated, is because all of a sudden people started buying, and that's when you see a high RSI in general, that means something is in a bull market, especially if the RSI stays extended for a long period of time. That means it's in the early stage of a bull market. Now, after that stage, what do you buy? Because that's really the question right now. So I would say start looking at LNG, because Qatar says it's going to be at least 5 years and more, something like $30 billion for them to repair their LNG capacity. So now, if that supply is offline, then who's going to benefit? I would say start looking at that. I would say start looking at fertilizer, particularly fertilizers in North America. The reason is North America still has cheap gas, so you guys can make a fertilizer much better than Europe or Middle East is now completely everything is shut down. So I think ICL got one of their plants hit, which makes white phosphorus. So you have all these disruptions happening in the Middle East, and your North American fertilizer companies are going to be the beneficiaries of that. So you can start looking into those areas. And if you're a US based investor, then the MLPs are great, because if you can handle the taxes, then that's one of the best ways for you to get. Someone's asking about bonds. I would say forget about bonds. If you need steady income, start looking at MLPs. So I would say that's where you should be looking.
Yeah. So anything you want to end on, because it's more, right now, just thinking about the market's under some stress. People are kind of out there going like, I don't know exactly where to invest, what exactly to do. What's your advice for these traders out here who are either over trading, confused, hanging on to losing positions? What do you think would be the best advice to give some of these traders currently?
So if you are net long over 100% of your account, and leaving aside euro dollars and bonds and stuff like that, if you're net long over 100% of your account, you're taking a crazy amount of risk right now. And even if you're long gold and that's a big position, I would say you're taking a crazy amount of risk. The best thing to do right now is to hold plenty of cash and look through each position and think, if this were to drop 20-25% tomorrow on no fundamental change, just a proper market panic, something macro that's happening which is affecting everything, a liquidity crisis, let's say. If you're holding something and it falls 25% due to a liquidity crisis, are you going to love it, hate it? What is your perception on it going to be? Now, if you have things that you're not really comfortable with holding, then you should just get rid of them right now, because a liquidity crisis is coming. So you really have to know what your pain point is and sell down to your pain point, because those pain points are all going to start getting triggered as soon as next week.
Nope, sounds good. And we're gonna end there. So thank you guys for joining us today. Questions about Indian fertilizer stocks. I think fertilizer generally is probably a good way to go. Not sure about Indian ones currently. I would probably stay away from India myself. Have metals got a way to go? That's a big question. Now, once again, let's look at the market. Let's just get an understanding where we're at. There's been a lot of stops that keep getting hit on a lot of the metals, precious metals, and so on. I think the base metals still have a way to go. I'm not sure about precious metals currently, but once again, let's just take some time, let this thing chill out. The dollar's been very strong. I think also, like Ashok mentioned earlier, like all of these are going to have supply disruptions. Not just going to be oil. It's going to be copper. It's going to be gold. It's going to be silver. Now, silver and gold have already made a big run. I'm not sure if those continue to be under pressure because they already made their run. That could be the question we have to really answer here. Maybe they already made their run. Once again, like if these things start to show strength and they start to get more back into uptrends, I want to be long it as well. I don't care how high the price is. If it's in an uptrend, I still want to be long, as long as the sentiment looks right and everything else looks right, which to me it still does in the metals. I think we're in the right environment for the metals to do well. However, they're not currently. So, just be careful with that one. All right, guys, I got to run. It's great hanging out. Kashop, thank you for joining me. As always, it's a lot of fun. I always learn a lot hanging out with you. And so we'll see you guys next week on Friday at 10 a.m. for the Holy Macro Show. And I'm hoping to do a video this weekend, possibly with Kevin. He was out of town last week. So I will let you guys know what's going on with that. So we'll see you guys soon.
Thanks, Jason. Bye, everyone.